In this video, we'll be talking about Forex candlesticks. Candlesticks are a popular form of technical analysis used in Forex. They display price movement over a specific time period. They tell us what buyers and sellers are doing in the markets. Candles can tell you who is in control. So, breaking down the candlestick, each candlestick consists of four main parts. In this picture, we have the open. As you can see, we marked this on the diagram. This is the price at which the period started. So this is where the price opened at. And we have the closed, which is the price at which the period ended. And in this diagram, you can see the open. It opened on the bottom and it closed on the top, making this a bullish candle. We have the high, which is the highest price reached during that period, and we have the low, which is the lowest price reached at that period. All right. For a bearish example, is just the opposite. The body is the middle colored area we have over here, and then we have the wicks, also called the shadows, which you can see in this diagram. All right. So bullish is where the price closed higher than it opened. It represents a buying pressure and it indicates a potential upward movement. On the other hand, a bearish candle, the close is below the open, so it closed lower than where the price opened, and it represents a selling pressure and it indicates a potential downward movement. And when it comes to candlesticks, there are a few common patterns that we often see that can help us make decisions about the entry and the exit. So the bullish engulfing pattern. This pattern forms during a downtrend when small bearish candle is followed by a larger bullish candle. This bullish candle completely engulfs the previous bearish candle. This pattern suggests a potential shift from selling pressure to buying pressure. And then the opposite, we have the bearish engulfing patterns suggesting a potential shift from buying pressure to selling pressure, indicate a possible downward reversal in the market. Next, we have the doji candles. This is formed when the market opens and bullish traders push price up, which bearish traders reject the higher price and push it back down. In other words, the market has explored the up and down options, but then rests without really committing to either direction. So with the doji candle, it can go up, it can go down. Now, reversal type number 1, we have the morning star. And the morning star pattern appears during a downtrend and indicates a potential reversal to an uptrend. And as you can see in the picture, we have the first candle, which is a long bearish candle representing the existing downtrend. Then we have the second candle, which is short candle with a small body, which may be bullish or bearish. It signifies a period of indecision in the market. The third candle is a long bullish candle that closes above the midpoint of the first bearish candle. It indicates a shift in market sentiment from bearish to bullish, and it suggests the buyers are gaining control. So on the right side, we have a diagram of an evening star, and as you can see, it is totally the opposite. And it occurs during an uptrend and it signals a potential reversal to a downtrend. And then we have the reversal type number 2. Now we have the shooting star and inverted hammer. So the shooting star is a bearish reversal pattern that appears at the end of an uptrend. So as you can see in the diagram, it's very similar to our reversal type number 1, but the focus is really in the middle candle, where we can see that we have a small body with a longer top wick for shooting star, and with a smaller body and almost non-existing lower wick, and that is basically a shooting star. For the inverted hammer, we have the same thing, where we have a small body, longer wick, and we can see a reversal pattern forming. So understanding the candles and candle patterns is very important when it comes to price action. Definitely have a good understanding on these patterns and how the candle forms, and I'll see you in the next video.